Now it's my pleasure to introduce our presenter today, Tim Smith, Ph.D., or Dr. Tim Smith. He is the founder and CEO of Wiglaf Pricing, an adjunct professor of marketing at DePaul University and an academic advisor to the PPS Certified Pricing Professional Program. In addition, he's authored several books, including the aforementioned Pricing Done Right, the value-based framework, pricing framework, proven successful by the world's most profitable companies. So with that, Tim, welcome. And I'm going to hand you control.
Well, thank you for having me, Nick. Let's see if I can.
You're welcome.
There we go. So you should see my
There
screen
you are.
now.
I see it.
All right, let's go. Pandemic pricing is the topic of the day. How you're getting pricing done right in today's economic environment is the question asked. So, there we go. Yes, I've written 4 books, most recently Pricing Done Right. I've also written a textbook on pricing strategy. I've served clients in life sciences, information technology, data, manufacturing, distribution. I've been in the news, like taking stock with Bloomberg, WGN Radio right here in Chicago, as well as Marketplace, NPR. That was a big deal to me. Oh, it made me feel good. Work with clients across the globe. Currently, I'm doing work in Indonesia. Yes, from Chicago. That's some late hours. But anyway, and I have a bunch of followers on LinkedIn. In other words, I'm legit. All right. So the challenge facing companies today, is your input cost, your parts, your components, they're all going up. Your logistics, actually shipping things from one place to the other, that cost is going up. The packaging that goes around your product, that cost is going up. And labor, it's going up. All these are putting pressure on companies to raise prices or else they lose money. But there's a fear. If I raise prices, maybe I'll lose my customers and reverse the gains I had during the pandemic. So what should I do? Is what these CEOs are asking. So let's take a look at some example code. This is going to be nothing new. It's just some Fortune 500 company, and look at the impact of price, holding all else constant. And if they have a 1% improvement in price, holding everything else constant, they would actually, this example company would deliver a 9% improvement in profitability. You can compare it with quantity sold and say, well, what if I, instead of like raising prices, what if I just sell more units out here? Well, that would only lead, for this particular Fortune 500 company, a 3% improvement in profitability. What about variable cost? I can always reduce my cost. Not now, but I could try to cut components out and otherwise reduce the cost. That would only deliver a 6% improvement in profitability. Price is more powerful. And if I try to cut overhead, yeah, that could deliver some improvement, about 2%, but price is simply more powerful. But go back to that question of the trade-offs. If I raise my price, I may lose some customers. I don't want to lose them. I need to keep them. What should I do? Well, let's compare the idea of raising prices and losing customers versus lowering prices and getting more customers. If I decrease my price, but I'm selling more units, at this Fortune 500 company, I'm going to decrease its profitability by about 6%. That's not good. On contrast, if I raise prices, accepting I'm going to lose some customers, 1% decrease in customers for 1% improvement in profitability in price, that leads to a 6% improvement in profitability. This company, and yours too probably, will find that, actually every example I show you, will find that if I raise prices by 1%, but lose 1% of my customers, I'm better off. Yeah. So how does this impact us in today's environment? As I go through this, I want you to keep in mind the famous Warren Buffett statement, if you have to have a prayer station, prayer session before raising prices by 10%, then you've got a terrible business. That's what Warren Buffett says. 10% is a lot of the money, a lot. I don't know, Warren. I don't know. Let's think about that. Let's look at a case study. A case study on pricing of bicycles. Bicycles? Yes, because there's something everybody can kind of relate to, and it's a simple business. You can imagine how bicycles work. What happened in bicycles during the great pandemic here? Overall, demand increased. People are looking, well, there was a long-term trend towards cycling anyway, but the pandemic kind of accelerated that because you can't go to the gym, but you want to work out, so let's go cycling, and it's a good thing to do with the family. So demand increased, but unfortunately, so did cost. All those components that go into making a bicycle, those costs increased as well. Supply was constrained because there were actual challenges in getting the components, like this beautiful gear cartridge you're seeing here, getting the components to actually fix and make a bike. So what would you do with prices if you're a bicycle manufacturer? You can't even deliver. You can't even make product right. You're dissatisfying your customers. You're trying to sell through distributors, and you can't even give your trusted distributors the service that you promised to do. I don't know what to do, they may say. Well, so we're going to look at this. And in 2020, shortly after the start of the pandemic, like I said, demand increased dramatically for this. Component shortages were experienced. And you think about the electronic components required for an electronic bike, an e-bike, those new battery-powered bicycles that everybody likes. Well, lots of people like, I don't. But anyway, I don't hate them either. They're just there. Okay, those e-bikes, you can't get chips. I mean, if you're making chips at Taiwan Semiconductor Manufacturing Corporation, TSMC, in Taiwan, are you going to make the chips for a bicycle manufacturer or for Ford and GM and Volkswagen? No, you're going to focus on the big customers. You're going to focus on the expensive parts, not the cheap little bicycle parts. And so, they were in the back of the line of getting silicon and getting circuit boards and getting any parts required to make an e-bike. And then you also have the issues of like handlebars, brake levers, logistics for these bicycles. I mean, the bicycle is, you may buy it in America, but it's actually a global product, okay? And you need the parts coming from Japan and from Taiwan, the cartridges, and they're going to be shipped over on the seas. And now you see the next problem. You can't even get the stuff off the boat into the States and LA. On top of this, the actual cost of shipping a container, a 40 equivalent unit container box from Shanghai to New York, used to be around $2,500 before the pandemic. That cost of logistics shot up to $15,000, according to The Economist in September. I mean, that's like a five-fold increase. Yeah, a five-fold increase in price just to get your parts that are going to be delayed anyway. So what do you do? In this next slide, you're going to see some different price increases on these parts. You got seat posts 20% up, cranks 20% up, handlebars 11% up, brake levers 14% up, circuit boards, jump down here, 1,700% up. That's not doubling, that's multiplying the price by a factor of 18. Yeah, that's huge. And there's magnesium, which could impact, some wheels are made of magnesium. They're really, really hard and fast and light. And that cost went up 17% as well. And then we have inflation overall. As the federal chairman, Jerome Powell, stated in November of just last year, it appears that factors pushing inflation upward will linger into this year, next year, but that was, a few months ago. And you even have inflation in cycles. The average selling price of a bicycle in the US was $346 in September 2021, up 28% compared to 2020 and 54% compared to 2019, according to NPD. So we are having inflation across the economy and in this particular industry. So what do you do? What do you do if you're a small bicycle manufacturing company? Maybe you only do $10 million in your product line a year. What do you do? Don't want to lose your customers. So here we'll take a look at a company called Karbon Kinetics Ltd. Karbon Kinetics sells e-bikes globally. Cool. And an e-bike is more difficult to make than a typical bike. Like a child's bike requires about 50 components, a mountain bike 350, but an e-bike, it's over 800. Any supply constraint destroys the ability to produce, and they actually had production problems. They just couldn't produce. They didn't have the parts. So it's a small business. The CEO decides not to raise prices because he's not able to satisfy the customers he has. He can't keep up with his promises, and he doesn't raise prices. He had to tell his customers there were delays, and actual production fell 40% below target. Now, because he couldn't produce, and his productions were short, and the cost went up, but he didn't raise the prices, he didn't make any money. Now, how do you live as a company without making money? If you can't make money, you end up dying as a company. It's not sustainable. It's not sustainable. And so Richard Thorpe, the CEO of Karbon Kinetics, looked at the horizon and says, yeah, this disruption, it's not ending. It costs money. It's a wild west out there. That's what he says. And there's an example of his cycle right there, the Go cycle from Karbon Kinetics with magnesium wheels. So what do? Well, Karbon Kinetics estimated the cost to produce a bike increased 25%. And finally, in 2022, he plans on raising prices. Belatedly, after making no money, maybe even losses, he's raising prices. Old prices were about $4,000 and $6,000. He's raising it to $5,000 and $7,000 respectively. He has two models in his lineup. He also acknowledged the production targets are going to be hard to hit if you don't get the parts, so he reduced the production targets by 50%. He states, yeah, I guess reality is the cost of our product is not going down. We have to raise our prices. We have to raise our prices. What would you have done differently? Would you have waited that long? Should he have waited that long? Is this like similar to your situation? Do you have similar problems with cost, logistics, labor? I don't know, packaging? Okay, you don't make bicycles probably. I get it. Maybe you're a bigger company, probably. I get it. What did you learn? I look at this case studies and yeah, cost and supply challenges were faced by Karbon Kinetics, which is just a small bicycle manufacturer, but they were also faced by their competitors, which had the same problem. It was an industry-wide challenge. You take a look at the demand had increased, which actually creates industry-wide pricing power. Economics 101, demand up, supply down, raise prices. That's what they should have done. They should have raised the prices earlier in 2021. Eventually, they did raise it. Notice that the price increase was acknowledged by the CEO. He associates it with the problem of cost. But it's not just a problem of cost, as you'll see in the future slides. Take a look at the supply demand. We got the pre-pandemic in red and the pandemic in orange. And pre-pandemic, demand is downward sloping, supply upward sloping. But during the pandemic, we know that the demand shifted out. So suddenly there's more demand because we wanted cycles. Moreover, supply shifted down because they couldn't get the components. You take a quick look at this and it's obvious price is going to go up. It's obvious. But, we'll talk about chicken in a bit. They were playing chicken. They were afraid. All right. Yeah, I hear you. Okay, so let's talk about chicken. Let's talk about, chicken, beef, pork, whatever. That's a commodity as it gets. I don't know what else to say. It is. And you got Tyson Foods coming out with some announcements in 2021. Now think about their competitors. Sanderson Farms down in, I think they're Arkansas. Pilgrim's Fried Chicken, based out of Pittsburgh, Texas. Well, owned by Brazil because of a stupid mistake by Lonnie Bo Pilgrim not to raise prices of chicken when the price of chicken feed went up. And he went bankrupt and had to sell his business. What an idiot. Anyway, Smithfield Foods, where in the same time that Lonnie Bo Pilgrim didn't raise the price of his chicken, Smithfield Foods did and eventually sold out with a good price to China. Smithfield Foods makes pork. Cargill, no small company there, only $100 billion a year in business. Hormel, Purdue, National Beef Packing, OSI, then they I think all the chicken for McDonald's, Cook Foods, and there's tons of competitors in there. And what's happening, just like when we started to use corn to drive cars, what's happening to the price of making meat, beef, poultry, etc.? Well, grain prices are up. That increases the cost of making a chicken, a cow, or a pig. And that raises the price for cattle by 20%. So now it's more expensive to get the cattle that you got to cut up for meat processing, meat packing here. Logistics, truckers. You've heard about the shortage in logistics and truckers. Yeah, that logistics cost climbed 30%. Input costs of ingredients, packaging, just packaging the meat, that all increased. Plus, we have problems with wages and benefits for workers. I mean, it's COVID. You need to have new protocols for how you manage the meat packing plant. And you have problems of sickness. You got to take care of your employees. And you got a problem of not having as many foreign laborers within your meat packing plant because of many reasons. So now we got to pay more. And it's harder to get people even to go in there and cut up a chicken or a cow or a pig. And then we have a problem with demand too. See, they used to sell more to restaurants, but during the pandemic, you couldn't sell meat to restaurants because the restaurants weren't really open much, right? So you started selling more meat to the grocery channel. Problem with the grocery channel is they need the meat cut up in smaller parts. And so it just required more labor, higher costs again. And then staff shortages, COVID plant closures, you read about it in the news. All these constraints reduced production by about 2% for beef, pork, flat for chicken. That's nice. Here's what Donnie King said about that. I can't think of a single thing that's either stayed the same or gone down. He's just facing cost increases across every part of his business. So what did he decide to do? November 15th of 2021, he announced, or he stated that he has already raised prices of beef by 33%, pork by 38%, and chicken up by 20%, 19. Results, revenue was up 12%. Earnings more than doubled, up by more than 100%. That's profit. With margins also increasing from 2 to 10%. He's selling a commodity, people, but he raised prices in a highly competitive industry faster than its cost increases and delivered more money, higher profit, and higher revenue. Keep that in mind if you say, oh, but I'm selling a Me Too product. He raised prices in a Me Too industry. We're talking about beef, pork, and chicken. Come on. And he grew his margins, his revenue, and most importantly, doubled his profit over the same time the year prior. What happened in the meatpacking industry? You can think about it. You know, the demand elasticity for meat is pretty well known. It's kind of stuck. But during the pandemic, your ability to produce was reduced. Your ability to produce was reduced. That's hard to say. And so prices should go up. And he raised his prices. All right, that's two industries. But you know, what about something else? You know, maybe this is just weird. I don't make a commodity. I don't make this weird bicycle. What? Let's look at silicon. Silicon chips. Yeah. Historically, the prices of chips only go one way, and that's down. You talk to people at Xilinx or at TI and Intel, they all say that the price of chips just go down over time. Not during the pandemic. In 2021, we started to buy a lot of PCs because we had to work from home, laptops and such like that, which increased the demand for memory, considered a commodity, but it's also used in mobiles, PCs, and data servers. Oh, and yeah, we started to use more web services. Think about how much time you spent watching Netflix this time. Yeah, all of this had booming downstream demand. So now the component shortages, this increases a lot of demand, but there's shortages because you only have so much capacity for the assembly of tech products. You heard about it in the car manufacturing industry. Imagine if you're a bicycle maker. So there was a buyer behavior shift where we suddenly needed a bunch of PCs, and that created a mismatch in the supply chain, and the capacity of making chips was constrained. Yes, you can build more manufacturing plants. Yes, they are building more manufacturing plants, but it does take a while to actually get them built and operational. It doesn't happen overnight. This is a manufacturing plant. And state-of-the-art ones cost $17 billion, that's with a B, dollars. That's a lot of money. A lot of work to get, operational. So TSMC told them they plan to increase prices for its most advanced chips by 10%, while less advanced chips used by customers like automakers will cost about 20% more. So they're raising prices on commonly used chips. The cheaper ones are going up more than the more expensive ones. The advanced ones were more expensive. The cheap ones are raising the prices 20%. The advanced ones, they're raising it by 10%. Pay attention to that. They didn't just raise prices across the board like it's peanut butter. They raised I guess not like creamy peanut butter, but like chunky peanut butter. They found the areas where you can raise the prices more. They raised it there. Where you couldn't, raised a little bit less. So they started being very specific and focused about where they're adding value, which leverage point can help you do. Where they're adding value, and they raised the prices the most, where they could do so. Were they alone? No. Similar moves were expected from Samsung Electronics, TI, Intel, Sony, and others. Samsung reported in October, revenue was up 10.5%, net profit 31% over the prior year. TSMC expected a 2021 revenue of $51 billion, up from $48 billion. That's $3 billion more dollars. That's a lot of money. What do they do with this money? When you make money, you can grow. When you lose money, you have to shrink. Do you want a company to shrink? So what they did is, investments. They grow. Samsung announces plans to invest $200 billion more in new foundries, including a $17 billion foundry in Taylor, Texas. TI, $30 billion investment up in Sherman, Texas. Taylor's more in the central. TSMC, $100 billion more investments. Intel, $100 billion more investments. I think they just announced it going into Ohio. If you're making money, you can grow. Yeah. Downstream impacts, yeah, the chip shortage, et cetera, they drove up tech prices. The price of a larger TV models have shot up about 30% to last year. Also impacts gaming, mobile phones, data centers, cars. And I look at yesterday's Wall Street Journal. Ford halts orders for low-cost pickups. They just stopped making the Maverick. They just said no. They just stopped making. They stopped selling them. So no, you buy our expensive stuff, or we're not making it. We're not taking that order anymore because they can't get chips. And the cost of chips have gone up. Yes, a car takes a lot of chips. Take a look at its, supply-demand curves. The demand during the pandemic shot out, but the supply can't go up that much fast. You've got to build new plants. So price is just going to go up. Three different ways in which you look at it, prices needed to go up in these industries. Okay, so you may not work at a semiconductor manufacturing plant. You may not make, is this really relevant to you? Well, let's take a look at a few other businesses, but a bit quicker of a pace. We got McDonald's looking here, October 2021, wages up 10%, input cost of food, labor, paper, other supplies, all of these raised by about 3.5% to 4%. COVID, closing stores, sounds like the other picture. 20% of all locations had been impacted. Decision, raised prices by roughly 6%. Now, you think about it, there's a lot of competitors out there. What did they do? Oh, they did the same. Not like collusion in an uncoordinated manner, they raised prices. Well, what happened? 6%, that's a pretty large price increase, especially since commodities only went up. Wait. They actually sold a bigger order size, better mix, and with higher prices. They had higher revenue. Same store sales were up 14%. Earnings up 22%. This is a highly competitive industry making nothing but a sandwich. They raised prices because their cost went up. Fortunately, their competitors did as well. Did all of them? No, but many did. Let's look at another thing. Darden restaurants. You may know them as the Olive Garden or Longhorn Steakhouse, Cheddar's. I thought they were also, never mind. They had a 4% inflationary cost increase. CEO states he'll be very cautious in its pricing decisions. We want to make sure this big group of customers we service feel as though they can still come to our restaurants, get an extremely great value for what they have to pay. Because at some point, the average customer will be priced out of casual dining if it costs too much. He's frightened. He raised prices just a wee bit. What happened to his stock? It fell 6% over the 3 weeks following. He's afraid to raise prices. I get it. I understand. So what do investors do? They say, yeah, maybe you don't have a good business. Campbell Soup, they said, yeah, we're looking at some more price increases, but the CEO says, there's a little more room. However, I do think there are still some boundaries. Yeah, the stock went up a little bit because he's actually showing greater strength about raising prices than he did in prior periods. Smucker, the maker of Jif, Folgers, Milk Bones, and the eponymous Smucker jellies, jams, and peanut butter. They reported again higher prices and higher costs, higher input cost of labor, transportation, packaging, they all went up. So what does the CEO say? The CEO, Mark Smucker, said we are delivering robust organic top-line growth in each of our segments, reflecting consumers' demand for our brands. Oh, he's so happy. Truth is, profits were down. Margins fell from 40 to 34%. That's a 6% drop in margins right there. That's huge. Yeah. So you start to sell the stock because he couldn't raise prices. He didn't raise prices enough. Kraft Times reported a 1.3% higher revenue, raising prices by 4.5%. However, their internal price volume mix analysis indicates the prices were up 1.5% overall, while your volume mix was down 1%. Price volume mix analysis, that's something you can read my research paper on. And if you need to, talk to me. CEO says, I'm incredibly proud of our team. We did better than expectations, but investors were unmoved because, well, revenue was up. The overall profitability was basically unchanged. Cool. So they were unmoved. Then we look at Carol Tomei. She works at UPS. UPS, they deliver. They are in the logistics business. They delivered an increase of 9.2% from the year prior, largely by increasing the revenue per item shipped. So you're now selling the more expensive stuff, just like Ford. Stop making the Maverick and buy the F-150, this expensive stuff. Increasing revenue per item shipped by 13%, while daily volume fell 2%. So you're selling more expensive stuff. You're selling it at a better price. You're accepting some volume loss. Revenue was still up. And she says, I'm going to follow it through by another 5.9% increase in price. Note you, FedEx said they would do the same a month prior. What happens? Stock market up. They love it. Union Pacific, one of those logistics companies, you know, they had all these problems. They couldn't meet their demand. Yeah, they faced a 74% increase in fuel costs, 8% decline in productivity. The trains weren't working as well, disruptions, shortages in chassis for unloading, wildfires, labor challenges, everything. Jennifer Hammond, CFO of Union Pacific, states strong demand supports pricing actions that yield dollars exceeding inflations. Result, income up 9%, even as volumes decreased 4%. The stock market responded positively. I'll note you that in this first case with Carol Tomei of UPS, in the year prior, where she just shortly took over CEO, she actually canceled contracts with customers because there were bad contracts. And it said, if you need to do business with us, you have to do it at this better contractual rate or terms. Yeah, that's pretty radical. Look at her performance. That's pretty radically good. All right. What about Mondelez? What about food? Mondelez, they also raised prices. They make Belvita, Chips Ahoy, Oreo, all sorts. Philadelphia cream cheese, Toblerone. They raised prices as well. They've been raising prices. We plan a price increase more than we've done in the last time that I'm here, and probably for quite some time. The CEO, net revenue up 8%, earnings per share up 14%. Procter & Gamble also announced they're going to raise prices. Notice the time. In April, they announced the price increase coming in September. So before they even raise the prices, they signal to the market, expect it. This gives a while for Hinkle and Unilever and other companies to realize, oh wait, the big behemoth down in Cincinnati is raising prices. I think we could too. They did it in a targeted approach. And how did the market respond? They responded positively. I mean, the targeted approach, Procter & Gamble says, I'm going to increase beauty and home and fabric by about 7%. But the grooming area, that was by only 4%, the healthcare by 3%, and the baby, feminine, and family care will actually reduce the price overall by 1%. Now, this is at the category level. Procter & Gamble probably went down to the product level, the single SKU level, to try to identify where they had power to raise prices and where they did not, where they needed to and where they did not. And leverage point, again, can help you find your pricing power. Okay, so here's question mark Rockman. He's asking the basic question, what does the I got competition, how does that impact the ability to raise prices? All these companies do not work in a vacuum. They all face competition. You cannot tell me that Tyson Food is not in a competitive industry. They're competing against Cargill, a $100 billion company, and lots of other companies too. McDonald's, that's a sandwich. A lot of competition. TSMC, Intel. I mean, there's a handful of companies that I can name that we can think of, but they are highly competitive. Bike makers, highly competitive. They all raise prices. I don't care if you have, I will grant this to Union Pacific and UPS. They have limited competition. And Union Pacific, one of its biggest competitors was a truck driver. They're in shortage. That helps out Union Pacific. So I'll accept that they get a, sure, it's easy for them, but even where it's highly competitive, they were able to do really strong pricing work. Actually, the ones in the moderate competitive area are the ones where you say, what about the demand? Does that shift? Yeah, it does. I mean, Union Pacific had higher demand because the trucking was a problem. UPS, we started ordering everything online and they got a lot more deliveries to do. Campbell Soup in the early part of the pandemic had a huge growth in demand as we started eating soup at home and lunch. But then at the later part of the pandemic, as restaurants started to open up, their demand started going back down again. So then people started to leave their house for lunch finally. So they've seen both. Darden restaurants had some, problems with demand. People being a little afraid to go to restaurants at all, etc. McDonald's drive-through, they did just fine. It was somewhat flat across these ones in the center. Does the nature of the demand shift? No, they all raise prices. So which are you? Are you afraid to raise prices? Cowering, saying, oh no, I don't know how to do it, I don't know what to do? Or are you gonna raise prices like a UPS or a Union Pacific, where you have the power and you're going to exploit it? Or a Procter & Gamble, where you're going to do a deep dive, identify the opportunities and raise your prices there? Mondelez, Samsung, Tyson, McDonald's, they all raise prices, very calculated as a mentally calculated, very prescribed approach to trying to deliver more profit. Which are you? See, companies that raise prices with confidence were successful, despite the competitive landscape and competitive intensity, and despite how the demand is moving around, because it's moving around, during this period of high cost inflation. They succeeded. Saying, but can I? I don't know. You need, some confidence here. Reality says costs are increasing for you. They're also increasing for your competitors. If I don't raise my prices, I'm going to start losing money, or I'm not making money, not meeting investor expectations. So I need to pass some of that cost increase over to my customers. I need to. Your competitors are facing the same problem. Now, if both of you raise your prices and respond in a rational manner, yeah, you may lose a little volume, but profits can be kept healthy. And, I don't eat market share. I eat on money profits. That's what, sustains a business here. If your competitors are not rational, expect heavy volume losses if you raise prices, or expect heavy profit losses if you don't, or maybe both. If you're not rational, yeah, you're going to have heavy profit losses. And you'll also see in yesterday's paper about a discussion on how suddenly the people are shifting their buying habits at the grocery store due to the raised prices of grocery items. This is expected. But without the profit, I can't sustain the business. Pilgrim's Pride Chicken went bankrupt, and they made at the time about 25% of the chicken in America. And it mostly sold through Walmart, but they went bankrupt because they refused to raise prices. And he said, I'll make it up in market share. Yeah, that's what Lonnie Bo Pilgrim said. I'll make it up in market share. He went bankrupt. Don't do that. I want to ask you, are you so spectacularly unique that you can't do the same? Are you so spectacularly horrid as a business? Is your industry that bad? Yeah. What must be done? Ask yourself that. That's what Wiglaf Toltec Mesoamerican dude says. What must be done? I think you know. Thank you.
Thank you, Tim, for sharing your insights. That was a great presentation. We've had actually a few questions come in during the webinar, so there's still plenty of time to enter them. So now is as good a time as any to enter them in the right-hand panel on your screen. And while you do that, just a few quick words on leverage point. So Tim spent time talking about the importance of managing pricing strategies to ensure profitability during unpredictable times. A great way to overcome some of these price pressure discussions is to focus on the differentiated value offering provides, and focusing both your strategy and your sales conversations on that. And Leverage Point helps you do that. We offer a SaaS solution that creates interactive digital value proposition that helps sales teams convey this value messaging in a more powerful way. How does it work? Well, first, you have your product, your marketing, your pricing team members collaborate on custom branded value models and messages to create a value proposition that just helps your sales teams tell a story. Your sales team can then access that value proposition in a cloud-based library that's accessible by every rep at the organization to customize in real time for each customer and prospect presentation. Finally, beginning with the first sales call, sales teams can basically modify this baseline data in real time in front of the customer or prospect in order to create a unique business case that the prospect can use internally to drive a deal forward. Early on in the sales process, these value propositions are super useful as flexible case studies and call prep and building sales confidence and qualifying opportunities. As you get to the middle of the sales process, Leverage Point value propositions provide customer value analyses that provide important consultative selling tool that address pre-sales challenges. And finally, when you get to the purchase stage and the decision stage, these value propositions become a shared custom business case to buy that oftentimes serves as the buyer's internal financial justification for purchase when it comes time to dealing with decision makers and procurement. So who wins when having value-based discussions using Leverage Point? Well, everyone. So because you can download these presentations in PDF or PowerPoint and send them along as a custom leave behind, they can be linked to Salesforce opportunities. Our clients usually see 5 to 15% higher close rates and 5 to 25% higher prices when using Leverage Point's technology. So if you found any of that interesting whatsoever, feel free to leave us a note or denote your interest in the survey, and we can schedule a custom demo for you whenever you'd like. So now I'm going to put my camera on because I didn't have it already, and it's time for the Q&A. So Tim, you ready?
Yeah. Let's see what we got.
So what are some good strategies for overcoming price objections in B2B sales conversations? Is there a certain type of shift in focus in that conversation you would recommend having?
Well, that's the whole point of this particular talk, is that you're actually going to have that conversation about price. I was looking over some syllabus because I got to teach again. And I was looking over a syllabus down at the University of Arizona where they teach pricing strategy. And the syllabus had this statement that, take a look at the other marketing variables. Your product, your promotion, your placement, your brand, your offering design, all of that's about creating value for the customer. Price is about capturing it. So in that conversation, yes, you are going to bring up price directly. You'll have the backbone to refer back to the benefits being delivered. And this is where the leverage point tool would come in nice, because you can actually quantify how important this is. And as the cost of competitors change, because that has to go up too, you can quantify the importance of taking this price increase. You can show them the benefits. You can show them the value. You say, yes, I know this cost increase is painful, but it must be done, or we cannot reliably deliver to you.
Yeah, and I think that makes a lot of sense, especially because using our technology, you can actually compare against a reference alternative, whether it's a competitor or just do nothing. Because I know a lot of decisions are made on do we do this or do we just stick with the status quo? So that's an important, definitely an important piece of the conversation. Got one about internal objections. So in terms of internal decision makers, where do you see friction in terms of people objecting to increasing prices as a strategic matter?
I hear it directly coming out of product managers often, because the product managers are like, I worked so hard to build this share, or I want the volume. I even hear I'll make it up in volume. I have returns, economies of scale. I'm like, you can't make it up in volume. Lonnie Bo Pilgrim went bankrupt for doing that. Your value as a product manager is related to actually delivering profit dollars, not just revenue. In these examples, they also pointed out that by raising prices, they increased not just profits, but they also increased revenue. And in this particular pandemic time, it's an opportunity to raise your prices faster than the cost of inflation and make some more money. So it's your responsibility to do that.
Makes sense. So here's a good one on this is about volume and frequency. I think this is an interesting one. So raising prices, this is not just a one-time decision. These are things that can change, can happen multiple times, because I would imagine these cost shocks aren't, they don't all happen at once. So many companies might be forced to make these decisions on an ongoing basis, require multiple price increases. How do you manage that in terms of dealing with these decisions maybe multiple times in a year?
I think that's where a lot of companies, especially in the CPG area, got caught flat-footed. They just simply did not have the apparatus to manage prices differently, to make price updates more frequently. I actually talked with more than one company that says, I technologically cannot raise prices in mid-year, because if I did, I would mess up my rebate calculations. I wouldn't know how to do it. So I'm getting as weird of answers as my technology doesn't allow me to do it. Often, it has become so clear during the pandemic how many companies are used to an annual price increase, if that. And the pandemic made it clear, like with the bicycle manufacturer or Tyson Foods with meat, annual price increases are not enough. I mean, with meat, you can change the price every day, sometimes is necessary. And the idea of like taking a set of customers and saying, I don't like the contract we have with you, it's not working for us, let's renegotiate them, meaning let's tear up our current agreements and make new ones, or we're not doing business with you anymore. That's a pretty radical claim. UPS was well served by it. This is an opportunity to raise your prices, but you need to have the apparatus, meaning the people, process, and tools, the organizational structure, or at least somebody on your side helping your CEO to not make a bad decision of chasing volume, like what Lonnie Bo Pilgrim did. And I bring up Lonnie Bo Pilgrim because, that wasn't that long ago. It was like 2004 that he had this big problem. Oh, we didn't have a big recession then. We had a big one in 2009. These business crises are going to keep coming at us. It's part of life. It's not like we can hide and be in a safe, golden place unless you work for, I'm going to say it, unless you work for the government. You're living in a volatile environment. That's the whole issue here. And you got to manage that volatility both when the cost goes up and when the cost goes down. And this is an opportunity right now to raise your prices. And if you don't, you may either be swallowed up or bought out or simply go bankrupt.
Makes sense. Yeah, so here's, I got one on a couple actually on irrational behavior. Basically you touched on that in an earlier slide, but what do you mean by irrational pricing behavior, and what are some general ways to kind of handle irrational behavior by your competitors in terms of their pricing strategy?
Well, this is where McDonald's comes in my mind, because not all of McDonald's competitors raise prices. Remember how long Subway's had the $5 foot long? They were stuck with it because they made songs about it until eventually it didn't work anymore because they couldn't make money. Yeah. And so McDonald's, I live in Chicago where it's wonderfully brisk outside. We have plenty of Vienna beef hot dog stands. If you order a hot dog in Chicago, do not ask for ketchup. No ketchup. Anyway, the cost of a hot dog did not go up much. Oh, Chicago's also the headquarters of McDonald's. Yeah, so we got the hot dog stands not raising prices, but people still go to McDonald's and they are raising prices. That's just reality. You have to make decisions given the reality that you work in. Yes, your competitors can be stupid. I remember the CEO of Continental, before it was bought by United, used to say, I can't price any higher than the stupidest competitor. There's some truth to that, but it's not all true because there is something else called value. If you're delivering value and you're communicating it and the customers see it and acknowledge it, they'll say, yes, my competitor over here is changing prices or staying low, but you're worth more. I can pay you more because I can't get this good of service, this good of product from anybody else.
That's actually a really great segue. So I saw one pop up on services actually. So I think a good chunk of the presentation was focused on input costs and the volatility tied with that. But services are a big component of many B2B businesses. And I love to hear what you're seeing on in the competitive marketplace on how these pressures are impacting the way companies price and sell services.
Well, it's causing some companies that used to provide services for free to either look at charging for the services or actually breaking it out and turning into another part. Peloton famously did that, where they sell you now a $350 installation fee. How do you buy a Peloton without putting it in your house? I don't know how that works out. But anyway, so basically, they are acknowledging this. You have people clarifying what it is their services do for customers and then trying to charge for it. And not all the customers are happy with it, but it happens. And UPS, I would argue, is purely a service business. I mean, it's just moving packages around, a service for another business. And they raise their prices quite well. They also, part of their price increase was related to acknowledging that Christmas orders that are not pre-placed, if you don't buy the capacity ahead of time in Christmas time, I can't run my processing plants properly, and then packages get late. And nobody wants the Christmas cake after Christmas. That's not good. So they were basically promising to get things to customers on time only if they reserve capacity. And if you don't reserve capacity, I won't serve you. So the services, yeah, those are going up too, related to the cost of labor and everything else.
And it's great for expectations management, I imagine, as well. Cool. So I think we have time for one more. So this is on it's actually a topic near and dear to our hearts: value pricing, value selling. So how does this fit in with value pricing and value selling strategies? How can they be deployed to help mitigate these pressures? Oh, I think we lost your audio.
You did lose my audio. Thank you.
We can hear you now, though.
I hit the
Just for a
wrong
second.
button. That's totally related to TSMC and where they started looking at some.
Oh, I think you hit the button again.
That's because my battery is dead.
Oh no. Should we?
Let me know.
Yeah, I can hear you.
Yeah, my battery on my little road thing just died. So,
Oh no.
yeah. But yeah, TSMC, they looked at their value proposition product by product to try to identify which particular products they can raise the price on. And that's what you need to do as well. And then communicating that with the leverage point tool to the end customer to help them understand why, the cost of your chip is going up differently than the cost of the next chip over. And this is part of what we have to do as businesses.
Makes perfect sense, and appreciate the mention. And I think that's about as many questions as we have time for today. So before we wrap, just a quick reminder for next month's webinar. We're going to be joined by another one of our longtime favorites, Joanne Smith. And we're going to be continuing the discussion about some of the pressures faced by today's B2B businesses. She's going to be diving into some of the struggles that enterprises are facing around supply chain challenges. This should be another really engaging presentation and a good continuation of the topic that we dug into today. So I encourage everyone to pre-register in the exit survey, and it should be a really good one. So that's it for us today. So thank you so much to Tim for presenting. This was a really informative presentation, and hopefully the audience got as much out of it as I did. And from all of us here at Leverage Point, hopefully you'll have a great start to your year, and I look forward to everyone joining us throughout the year for our webinar series. So thank you.
Thank you, Nick.
Thank you. Take care, Tim.